If you try doing prop firm challenges, you already know. The typical advice of just risking 1% per trade just doesn't work. You got time limits, trailing drawdowns, and the mental pressure that comes with doing these prop firm challenges. And I've been there. Blown accounts, resets, frustrations, until I found a system that actually works. It's a system that got me six-figure funded and led me to real payouts. Today, we're going to talk about how to pick the right challenge, which firms are worth your time and money, and how to actually build a risk management plan that actually fits your trading style. And this is the framework that I wish I had when I first got started. So smash the like button and watch until the very end. You're gonna get some things that are very valuable that you could take back to your trading. Let's get into it. All right, so before we even talk about risk per trade, we have to talk about the challenge itself. And this was a huge mistake that I made early on, and that was picking the challenges based on the wrong things. Now, when you're picking a challenge, there are two critical things to analyze. First is the end of day drawdown with trailing drawdown. And this is huge. If you have the choice, especially when you're first starting out, always go with the end of day drawdown. And the reason is that end of day drawdown is a lot more realistic and also a lot more forgiving. Your max loss limit is calculated based on your end of day balance. This means that you could manage trades, take partials, and even sit through some heat without your drawdown creeping up on you with every tick. And this actually feels like real trading. Now, the trailing drawdown isn't all bad. It has its place. Apex use it, and they offer amazing scalability, and they're typically cheaper. With Apex, you can even sometimes get $50,000 challenges for as little as $37, and that is crazy. But you have to understand that doing those challenges with a trailing drawdown requires a completely different approach, one that is way more aggressive. With the trailing drawdown, your drawdown limit comes up with you with every unrealized gain, which means that a winning trade can actually work against you and bring you closer to losing that challenge. And it's just a much harder environment to pass. So unless you have a strategy that is specifically for that pressure, make it easy on yourself. Always go with the end of day drawdown. Second is the profit to maximum drawdown ratio. Now, this is something that not many people talk about, but it could be the killer of most challenges. You see a $300,000 challenge and your eyes light up. And I used to be the exact same way, so I'm not blaming you. But that number is meaningless without context. But what you need to look at is the risk to reward ratio of the challenge itself. Let me explain. So whenever I'm looking at these challenges, I'm looking for it to be as close to 1-to-1 ratio as possible. What does that mean? It basically means that a prop firm would say something like make $2,500 without losing $2,500. So that 1-to-1 ratio, in my opinion, is very fair. Now, most prop firms don't have a 1-to-1 ratio, but the key is for it to be as close to that as possible to make our job easier. So let's go through three firms here and I'll show you what I mean. So on Top Step, for a $50,000 account, the profit target is $3,000 and the maximum loss limit is $2,000. Divide 3,000 by 2,000, that is 1.5 ratio. That is still pretty good. Now, if you look at their 150,000, right, which is for $149 per month compared to $49 per month, that is 9,000 to 4,500. So now you're looking at a 2 ratio instead of a 1.5. So now this is a little bit of a tougher challenge for you to pass because you have less room for your drawdown and you have a higher profit target. And on top of that, you're paying more for this challenge as well. Now, if you look at something like Funded Next, which is one of my favorite prop firms at the moment, and I've made a whole video about Funded Next as well that you could check out in the description. And when you look at theirs, for a $50,000 account, your profit target is $2,500 and your maximum loss limit is also $2,500. So that isn't exactly a 1-to-1 ratio, which is very rare in this industry, and which is why Funded Next is one of my absolute favorite prop firms at the moment. And then if you look at Apex, for example, now we're gonna look at their, let's say, trade away 300,000 plan. Now, for me, a few years ago, I would look at this and say, oh my God, $300,000, and my eyes would light up, right? But when you look at it, you see that the profit target is $20,000 and the trailing threshold. So this is not only not end of day, but it's a trailing drawdown of 7,500. So when you divide that, what is that? 20,000 divided by 7,500, that is a 2.6 ratio. So this becomes an extremely difficult challenge for you to pass because not only is it trailing, but also it is a lot less wiggle room compared to the profit target. So this is what I mean when you're going through the plans, always compare that profit target to your maximum drawdown to try to get it to as close to one-to-one as possible. Of course, there's no right or wrong answer, but for me personally, instead of going for that harder challenge, I'd rather go for that smaller one and stack them up. So instead of going for a $300,000 challenge, I'd rather go for multiple $50,000 challenges, which are easier to pass, and then copy trade them across multiple accounts. Not only do I put the odds more in my favor to pass that challenge, but also psychologically, it's easier for me when I have the same risk across all of my accounts. I don't have to think that what am I risking for my 50Ks, what am I risking for my 300Ks. Everything is the same. I'm doing the same risk management and I'm copy trading. So now that we have picked a fair fight, let's talk about the risk management. And I'm not going to give you that generic risk 1% per trade. That advice used to drive me nuts. It ignores everything that actually matters. Your strategy, your goals, your trading frequency, and your personal psychology. So what we need to do is build a top-down framework built around your trading behavior. And here's how we're going to do it. It's a very simple 3-step process. Step number 1 is to know your trading frequency. And you need to be honest with yourself and think how many trades you take per day and how many trades do you take per week. Now, if you have a journal, which you should have a journal, you could look at your journal and see how many trades you take, or just think about the last few weeks. How many trades did you take per week? For me personally, I take about 1 to 2 trades per day, and on average, I take about 5 trades per week. Now write this number down. Step number 2 is to define your risk buffer. Now you need to ask yourself a simple but powerful question. How many trades in a row are you willing to take before you need to take a pause and reassess? Now this number doesn't mean that your strategy is broken, it's just a number that you're willing to accept before you take a pause, you lose that challenge or you lose that account, and you kind of go back and you reassess things. For most traders that are doing challenges, this number falls somewhere between 5 to 20 consecutive losses. So for now, let's pick 10 as a baseline. Then this becomes a risk buffer. So if I take 5 trades per week, a 10 risk buffer means that I could go on 2 weeks consecutively losing before I lose that challenge or I lose my funded account. And this gives you incredible mental breathing room. It becomes your personal risk parameters, and it's set in stone before the emotions of trading kick in. Now, step number 3 is the formula itself. All we need to do is just do some simple math. Your max drawdown divided by your risk buffer equals your risk per trade. That's it. That is your number. It's clear, it's personalized, and it's built on a logical plan, not just some random rule. So let's walk through a real example here. If I'm taking a $50,000 top step challenge with a $2,500 maximum drawdown, my chosen risk buffer is 10, meaning I could go on 10 losses consecutively before I blow up that challenge. $2,500 divided by 10 is $250 risk per trade. Now I have a plan. Now I'm not guessing. I'm not being emotional. The beauty of this framework is that it's completely customizable. You could adjust it based on your goals, based on the market conditions, and how you're trading. So for me, I think about this as 3 different modes. The normal mode, or my default, is basically what I just told you, the 10 risk buffer. It gives me 2 weeks cushion. I know that I could go on 2 weeks of terrible trading before I blow up the account. And for me, it's very rare to go on 10 consecutive losses in a row. So now let's say that I'm going through a challenge and I want to pass it faster, or the market conditions are extremely good and I'm trading really well. And here is where the aggressive mode comes in. Instead of a 10 risk buffer, I might want to tighten it to 5. So using the same formula, 2,500 divided by 5 is $500 risk per trade. Now the risk is double, but I'm making a conscious choice. I know that if I have 5 consecutive full losses, I'm going to lose that challenge or I'm going to blow up the account. I'm making that conscious choice there. And in my case, since I take 5 trades per week, I make that choice that if I have 1 week of bad trading, I will lose that challenge. Then we have the conservative mode. Let's say that the market is choppy, you're not trading well, and you want to become a little bit more risk averse. And here, I might want to change my risk buffer to 20. So the same formula, $2,500 divided by 20 is $125 risk per trade. Now what this does is it forces me to reduce risk and protect my capital without stopping trading altogether. And this is how you weather the storm. Do you see how powerful this is? By doing this, you're no longer just trading and guessing. You are a risk manager and you're adapting to market condition based on a clear plan. So let's say that you're taking this trade over here, which is a rejection off of the previous day low from a 30-minute liquidity graph, and you want to get in on the break of that candle and you want to target this swing low over here, right? And from your risk parameters, you've decided that you're going to be risking $500 per trade. So what you do is you come into the short position here, you click here and you bring it to where your stop loss would be. You double click it and you make sure that this is 500, the lot size is 1, and here is going to tell you the quantity. Now the quantity, obviously when you're taking futures trades, you want it to be exact. So then what you do is you just make that exactly the quantity you want. So in this case, it will be 7 shares. Your risk is above the wick off of that 30-minute rejection, and you're getting in on the break of that candle, and you're going to be targeting the swing low over here for about a 1.9 hour trade. And this one exactly would be 7 shares. And obviously you might not hold it. If it reverses on you, you might not hold it all the way to stop loss. You may get out your trade earlier, but your max risk per trade is $500, which is right where your stop loss is. I don't have a set of 1 minis or a few micro trade, because for me, it changes based on where my stop loss is. But what is constant for me is my risk per trade based on the bigger framework that we've been talking about in this video. All right, so now that you have picked the 𝗧𝗢𝗢𝗡 and you have a personalized risk management plan, the next step is just execution. And this is where your trading psychology comes in. And the whole reason that we have this plan is to defeat the 2 biggest enemies of trading, which is fear and greed. It defeats greed because when you are on a winning streak, you don't just suddenly increase your risk. The plan is the plan. It keeps you humble. It defeats fear because when you take 2 or 3 losses in a row, you won't panic. Why? Because you've already planned for an X number of losses in a row. It's part of the process. You knew it coming in and you are prepared. Stick to your plan, trust your strategy, and respect the rules. And this is what separates the consistently funded trader from the person that is stuck in the challenge loop forever. And there you have it, guys, a complete framework in regards to risk management for prop firms that changed everything for me. Now I want you to do something. First, smash the like button, consider subscribing to the channel if you have not already, and take a moment to actually calculate your numbers. And in the comment section, drop a comment and let me know what is your risk per trade using this framework. And do you typically like to do a normal mode, an aggressive mode, or a conservative mode? I would love to hear from you. I read and value every single comment that is made on this channel. I don't claim to be some trading guru. I'm just a trader that's been doing this for over 5 years now, and I'm sharing everything that I've learned, and I'm learning every single day. So I hope that you enjoyed today's video. Thank you for watching, and I'll see you in the next one. Peace.